In long-term trading and swing trading, a trader makes money when they enter at a lower price and they exit at a higher price. Like you can see in this example, that the trader is entering at the rate of 100 rupees and exits at a rate of 300 rupees. This way, the trader is making a profit of 200 rupees. And same is the case with intraday. If a trader is buying in intraday and exit the trade in the same day, say example, the trader enters at 100 rupees and exit the trade in the same day at 150 rupees, the trader is making profit of 50 rupees. On the other hand, if the trader in the intraday enters a position of sell, enters at 150 rupees and exits at 100 rupees, then the trader makes a profit of 50 rupees. So in all these three cases, either the price is moving up or the price is moving down. What do a trader do if the price is moving sideways? Yes, the price is continuously moving sideways. Then in that case, what will a trader do? Hi friends, Professor Joe here. I hope you all are doing great. Welcome to this video. In this video, we are going to understand in a sideways market how a trader can make money. As you've already seen, in long-term trading and swing trading, when the price goes up, the trader gets an opportunity to make money. In intraday, when the price goes up or when the price comes down, the trader gets an opportunity to make money. But what when the price is moving sideways, a range-bound market? So to make money in the range-bound market, there is a strategy for which we will first have to understand what is a short call, what is a short put, and then we combine it together, what happens. So let us see. Now in a short call, on the left side, what you can see is a short call simulator, wherein it is very clear that when the price goes down, that is when the price moves bearish, in a short call you make money. And when the price goes bullish, the traders start going in a loss. Now on the right side, you can see the same is explained with a smaller diagram. Here you can see when the price is going down, which you can see in green color, from the strike price. So the trader enters at the strike price and the price is going down, the trader makes money. But when the price goes up, you can see it is marked in red that the trader is getting into a loss. Quite obvious because it's a short call. When the price goes down, the trader is making money. And when the price goes up, the trader is losing money because that's what the trader had predicted. But what you can see over here is when the price moves sideways, the trader is still making money. Why? That is because of time decay or theta decay, like you can see on this diagram. As the option moves towards the expiry date, you can see that the premium is reducing and finally becomes zero. In a sell, the trader enters a short call by taking in a premium, and the trader will only make profit if the premium goes down. So because of theta decay, if the price remains at the same price or at almost the same level, the premium reduces, eventually it might even become zero, and that's how the trader will make money in a short call. The same is the case in short put. In short put, the trader makes money when the price is going up. But if the price starts moving down, the trader will hit a loss. And the loss keeps increasing as you can see in the chart. But you can see the same thing over here. The price going up, the trader is making money. The price going down, the trader is losing money. But when the price goes sideways because of theta decay, the traders is making profit because the premium is gradually going towards zero. Same thing, the trader enters a short put, collects a premium, and when they have to buy it back or square off the position, if the premium is lower, they are making profit. Now, I would like to explain that how in a short put and a short call, the trader is making profit. Now, I have explained this chart in multiple previous videos. I am putting the link for short call, short put, and short selling in the description. So if you are confused, you can go back to those videos and clear yourself. Now in step one, what is happening? is the seller is borrowing 100 options from the broker and entering into a position by selling those options in the market. So the trader borrowed 100 options, sold it for 100 rupees and got 10,000 rupees. Now for convenience purpose, we are not going to calculate the brokerage or any other charges. So here the trader has pocketed 10,000 rupees. Now when the premium goes down, either because the price moves in the direction which the trader expected or because of theta decay, the trader will buy back the option. Now in this case, we have shown that the option price is at 50 rupees currently. So for the trader to buy back 100 options, the trader have to spend 50 into 100, that is 5,000 rupees, and give it back to the broker. So now what has happened? The trader opened a position by selling the options and closed the position by buying the options. When the trader sold the option, the trader got 10,000 rupees. When the trader buy back the option, the trader had to give 5,000 rupees, in the process earning 5,000 rupees profit. So this is how the trader profits in a short position when the premium goes down. Now let us look when the market is moving sideways, what happens? Now we have drawn a support and a resistance, which is a zone of 1000 pips. And the middle point is 500 pips from the support as well as from the resistance. Now if the trader goes for a short put, the trader is making money when the price is above the strike price or around the strike price. But if it goes down, the trader is making a loss. At the same time, if the trader goes for a short call, then the trader makes money when the price is below the strike price or in and around the strike price. But if the price goes up a little bit towards the resistance, the trader will make a loss. So now what can a trader do to avoid such a situation? If they put short put and the price goes a little bit down, there is a probability of loss. If they put a short call and if the price goes up, there is a probability of loss. So how to overcome this probability? So to overcome this probability, the trader can combine a short call and a short put. Yes, the trader can combine a short call and a short put and make it into a short straddle. Now this is how the short straddle looks like. So if the price moves in this 1800 points range, the trader is making a profit. When it is in the center, the trader is making maximum profit. And when it moves towards the support or towards the resistance, the trader's profit will be reduced but still make a profit. Now I know a lot of people are confused when they look at this simulation or this chart. So let me just flip this chart onto the bar chart. Let's have a look how it looks. I have flipped the simulation chart and on the side we have the bar chart. Now I'm sure it is clear that if the price is moving between the support and the resistance, the trader is at a profit. Now remember, in this case, our support and resistance is in a range of 1000 points. And taking this simulation into consideration, if the price moves between 1800 points, that is 900 points down and 900 points up, if the price is moving between that at the time of expiry, then the trader will make profit. So this is how, by combining a short call and a short put, a trader can profit in a sideways market. So basically, in a short straddle, you are making money when the price is at the strike price or a little bit above the strike price and a little bit below the strike price. Now let us understand the features of short straddle first so that you can understand the features of short strangle. In a short straddle, you are entering at the money. That means the strike price is at the money. You enter with the same lots, you enter with the same expiry, and you enter at the same time. Whereas in a short strangle, the only thing that is different is you are entering at OTM. When you are entering into a short straddle, you are entering at ATM. Your strike price is at ATM, that is at the money. And few things you have to remember that the lot size has to be the same, the strike price is the same, the expiry is the same. This way you get a range, a decent range. When the price is moving sideways, you can make a profit in. But if the range is bigger, then you can go with another strategy which is called a short strangle. Now, in a short strangle, what is happening is you're getting a bigger range. But the difference between a short straddle and a short strangle is in the short strangle, your strike price is OTM, out of money, so that you get a bigger range. Now, because the range is bigger, you will see that your profit is reducing. Let us have the look at this chart. So there you go. This is how a short strangle looks like. You can see that the range from 1800 points have now increased to 2400 points. But in short straddle, you could see in the center, it was a peak wherein you would make a higher profit. But here, because the range has been increased, the peak is cut down and become a plateau. It's flat. Because of which your profit might reduce a little bit, but the range between the support and resistance has increased to 2400 points. Now let us flip this chart alongside the candlestick chart so that you get a better understanding of how the range has increased. There you go. You can see in this candlestick chart, the range is 1000 points. You have entered a short put and a short call in OTM, that is out of money, because of which earlier that 1800 points, now you can see has increased to 2400 points. So now, if you think that the range is going to be big, enter with a short strangle. And if you think that the range is going to be small, then you enter with a short straddle. I hope that this explanation has made it very, very clear that when the price is in the range bound market, you can enter using short straddle, or you can enter the markets using a short strangle and profit out of it by the time the option reaches its expiry. Now, as I always say, that before understanding everything, please do not start trading options, because in options there are a lot of concepts. The most important concept is theta decay. You need to understand all these options very, very clearly. Then only you should start trading options. So you must know what is a long call, what is a long put, what is a short call, what is a short put, what is strike price, what is ATM, OTM, ITM, what is expiry date, what is theta decay. All these things you must understand. Only after that, start trading options. But in a sideways market, trading options is one of the best options to make money. Now remember, risk management plays a very, very important role. Whether you move into a short call or whether you move into a short put, or whether you go with a straddle, whether you go with a strangle, remember to place your stop loss, because sometimes the market can move in one direction after a breakout and never turn back. In that case, at least the option that is going in a loss, you will exit that position, and the option that is going in a profit might give you a profit or at least a break even. This way, you will not damage your equity. In this video, we have tried to explain short put, short call, what is a straddle, what is a strangle, and how you can profit out of it. I hope it has helped you to understand how to make money in a sideways market. But friends, what is most important is you have to practice patiently and you should have a lot of persistence. So practice, patience and persistence is very, very important if you really want to become a good trader. Friends, if you love the content that you are seeing and the way I am explaining, kindly like these videos and share these videos. So like you, there might be other people who are confused how they can make money in a sideways market. They will get to know what they can do in a sideways market and earn money from the markets. I have already created a lot of content and I will keep creating contents in trading, finance, banking, and personality development. So to get the latest update on my new upcoming videos, kindly subscribe to this channel so that whenever I create a new video, you will be the first person to know. Friends, all I can say is keep learning, keep growing. Thank you. Namaskar.